But things can happen. I mean, again, we have a significant segment of production that is managed by OPEC. So you have to basically embed in that a call on what OPEC's going to do. You have to embed into it a call on demand, but you can get a demand surprise. Rates play a big role because of, again, a macro trader. And then you can just get overtaken by a sentiment event. I mean, I think back to periods where we've had sell-offs in oil based on a broader macro concern about the credit market in China, but you get towards year end, and then all of a sudden you look at the market and you're like, oh, oil actually held up. It wasn't spectacular, but it held up in China. And so you have to think about all these factors. And then geopolitics comes in as well. And we've had, two surprises. We had the Russian invasion of Ukraine, and then we had the situation where I think is evolving in the Middle East. I don't think we're done with this story.
All right, welcome to On the Tape podcast. I'm Dan Nathan, joined by Danny Moses. Guy is off this week, a well-needed vacation. Danny, what's up?
What's up, my man? Great to be here.
It's great to be in the studio here. We got a lot of stuff to go over, but first, I got to tease this, a conversation that you and I had with Helima Croft. She's a managing director and global head of commodity strategy at RBC Capital Markets. Her return to the On the Tape podcast.
You worked at the CIA.
Yeah,
was involved in OPEC negotiations, flies all over the world.
Yeah.
The insights she gave us were unbelievable. People need to stick around for that, honestly.
Well, especially when we talk about the volatility that we've seen in commodities, other than, currencies, it seems like some of the only sort of volatility we've seen, it has not seeped its way into the broad S&P 500. It definitely has in some of these energy stocks. So we talk about that with her, and we go through a lot of this geopolitical stuff. So, stuff that we're not exactly equipped to do. Danny, we got a lot of stuff to talk about, plenty of stuff on the single stock front. We're recording this Tuesday afternoon. You're probably listening this to on a Wednesday, maybe Thursday.
I'm sure it's the first thing people do, right?
Why not? Well, right. I mean, listen, you know what? I think about this. I listen to podcasts like when I'm walking the dog, when I'm in the car, when I'm on a... I don't know.
That was a good British. I love that podcast.
Yeah, all right. All right. Let's talk about some of the data. We had Fed Chair Powell speak this morning on Tuesday. We have the non-farm payrolls for June on Friday. There's a bunch of other data out there that, I don't know, man, it's kind of hard. This narrative about a weakening consumer. Last week, we had consumer confidence data that was kind of better than expected here. So a lot of cross currents.
Right.
Yeah. Let's talk about what you thought about Fed Chair Powell and what he had to say today.
So he's speaking in Portugal, gathering of central bank governors. I think Sarah Eisen was there interviewing him, I believe. And he basically said they've made, quote, quite a bit of progress on inflation, but he wants to see more come down before. So if you look at the CME Fed Fund Futures tool, you're basically at 69% that there's a cut by September.
Good number.
Chance in July, and then 69. So that's basically lines up, I think, with what he is kind of saying there. I think the fear is that the economy is slowing a little bit faster than he may want it to, and he gets caught in a situation where inflation hasn't come down to the level that they want to see, and then he cuts rates. And so we have a jobs number coming out on Friday, and there's a lot of stuff out this week. And I know it's a half trading day on Wednesday. Thursday, the market's closed. Then we get the jobs number Friday, and rates have gone from the 10-year 420 to 450 almost. We're hanging out at kind of 445, and the 2-year has even been more active, I think. And so I don't know, 188's the number when the 4% unemployment. If you see a 130 number and a 4.1%, I can't tell you how the market's going to trade.
What if you see a 210 number?
I can't tell you I think the market trades up on a 210 number because I think the belief would be that inflation is on course to keep coming down. Now, keep in mind, people out there, that the numbers on inflation, this is key, on a comp basis, which Powell knows are going to start to look more hawkish by nature because they dropped so hard on the back half of last year. So just remember, when you're looking on an absolute basis versus a relative basis, what it's going to look like. And I think he's forecasting, or he's thinking in his head, you're going to have an up number. Now, might still be under 3% and north of 2.5%. But anyway, so Dan, I don't know. If I really was bullish on the market and everything like that, I'd want to see a big number.
Well, Danny, you have a podcast here. You're supposed to know. You're supposed to be definitive.
Honestly,
on a
at this
podcast.
point, I'm just throwing darts.
But here's the thing. To me, I think the way that rates have come back up, the strength in the dollar of late, I think if it's a hot number, I'm hard pressed to think that the stock market trades up on that. And if you just think about this, we're going to get into and you and I are going to talk about this. But
210 is not a hot number, just to be clear.
Well, if it's 188, what if it's 230?
No, but I think more important, the unemployment ticks back to 3.8. Because it was an anomaly in the ratio. I think that's just as important. So I think I'll answer that a different way. If unemployment has a 3 handle on it instead of a 4, and we're north of 200 in jobs, Fed's not going to be cutting anytime soon.
Right. So to you, to you, is that the biggest risk of the market here? Or, we have an S&P that's up, nearly 15% of the year, and it's just been hanging out around all-time highs. We have a NASDAQ composite up 20%, and we have the NASDAQ 100 up about 18.5%. And again, we've talked about this a lot on the tape and on Market Call. We've seen a lot of multiple expansion. And usually you see multiple expansion. Okay, sometimes you'll see it in an inflationary environment. So that could make, you could make the case why equities could keep going higher, even if we have inflation stop going down. So my one question for you, though, is that in 2021, the biggest criticism of the Fed and Fed Chair Powell in particular is that they were very slow to identify inflation. Do you think there's a chance, that they're slow to identify a weakening economy and keeping rates too restrictive for too long?
I think that once they start cutting, they're not going to stop, to answer that question. Meaning, I think once they get a taste and they see what's going on, there's a reason that they're going to cut. And the reason they're going to cut is not that inflation came down enough, it's the economy is slowing. I think that's what he's going to err on, is what I think. And in that case, Dan, I think that poses a problem because I think he won't stop cutting. I think inflation then could feed on itself and move itself higher. So I think we're seeing in real time that the economy, at least some of the economy, is weak, is remaining weak, and is potentially getting weaker. And you still have kind of the top half of the consumer running. And I do believe that there's this belief that a change in Washington, some type of political regime change, will be, quote, beneficiary for stockholders and lower taxes and stuff. And I think that started to build its way a little bit into the market as well. So, and I was thinking about this earlier, just to answer your first part of your question about kind of where these stocks trade in tech. Sitting on the desks like you were in 99 and 2000, trying to justify or validate valuations and saying, oh, you're not so much different this time, but no, these companies are growing. And then when it bursts, you look back and you say, what in the hell was I thinking about? Of course, those stocks were expensive. And so the longer that this goes on in terms of these stocks outperforming, the breadth, which we talked about last week with Mike Wilson, remains higher. You are seeing companies that are more economically sensitive, not to a sector, a macro trade, a secular trade, obviously with AI, get hit. It's happening. And so money is staying in the S&P 500 though, Dan. It's the one thing, and it's just finding its way into some of these bigger names.
It's funny. So we're going to talk about banks, kicking off earnings a little bit. You used to think that banks are kind of economically sensitive. It looks like every day, I pull up my FactSet, machine and I look at the news and there's a news story about private credit, about commercial real estate, about some of these money center banks that have a bunch of this exposure, on their balance sheets. But again, we see a handful of the money centers, at 52-week highs. JP Morgan has just blown out and made new all-time highs. I want to just remind everybody on April 12th, when the company reported their Q1 results, Jamie Dimon was cautious on net interest income. It caused a 6.5% gap in the stock lower. I can't remember, we talked about in the pod, the last time we had a one-day move of 6.5% to the downside in JP Morgan. Well, it only took a few weeks for it to fill in the gap, and then a couple months later, just kind of breaking out to new all-time highs. Danny, if on April 12th, Jamie Dimon was cautious on NIMs, how do you think he's going to sound on, July 12th, you know what I mean, when they report? I think it's the 12th, because, if look at what the 10-year yield has done, it was basically 4.2% then. It went up to 4.8%. It went down as low as 4.2% a couple weeks ago. Now here we are at 4.45%. So talk to me a little bit about that, because I'm hard pressed to think that this is a good setup for JP Morgan raging into its Q2 earnings.
Let's look at the sector first and then dive into names. So sector has been benefiting, obviously, from a return of M&A to a degree, return of the IPO market, though it's really been nothing special, but it has come back, general trading activity and so forth. The other thing it's benefiting from is the belief that if things, again, to bring it up, because it's going to be a major issue, change in Washington, what does that mean to the banks? The banks are the most exposed to what happens in D.C. by far, just the regulators that are on them. So if things loosen up for them, what else happened? The stress test came out. The big banks were all fine, increased their dividends, et cetera. To the point about J.P. Morgan, and he said it then, and I think he said it in the interim, and he'll probably say it again. As far as stock buybacks, you're not going to obviously get that at these levels. He's made it clear that he thinks the stock's expensive. There's other ways to return money to shareholders. But I think when you think about if I have to own one bank, right, it's J.P. Morgan. Now, what issues does he face, to your point? Net interest margin compression, credit, which is still fine. And let's keep in mind something else. The non-bank system has taken a lot of stuff over. So from a growth rate perspective, it's not going to be anything special. And it's pretty easy to figure out earnings for a lot of these companies for the most part, unless there's a huge prop component, proprietary trading component like you might see at Goldman or Morgan Stanley. So I think it'll be, quote, predictable. But you bring up a good point. And I just think I need to own financials. I need exposure to it. What can I be safest in? And it's J.P. Morgan.
All right. So let me ask you this, though. If you said that capital markets is starting to come back, why isn't Morgan Stanley and Goldman Sachs, breaking out? They're consolidating here. They did break out, in April and had some very nice moves. So they're consolidating some of those gains here. But you would think that those are pure play investment banks and should be acting a bit better.
They've had big runs, though.
Yeah, they have. I mean, they're consolidating. You'd say that's pretty good. J.P. Morgan is a bit of the anointed one. But one of the things I think is really interesting, we talk about it a lot, so I don't mean to be a broken record. Look at the KRE, which is the Regional Banking Index. If we do have a regime change in 2025 and we do have regulation lighten up, that might be a disaster for this group that's down 10% from its 52-week highs in late December, down 40% from its 2021 highs. Isn't there a pocket of risk there that's not particularly being appreciated, or is it being appreciated by the lack of performance on a relative basis?
I think it's showing already a lack of performance, but I would argue the opposite. I would say that M&A could run wild in all sectors, right? In all sectors. And so you might see a lot of consolidation. But to your point, Morgan Stanley, Goldman Sachs are more exposed to leverage that funds have, more exposed to a downturn in the stock market, so there's a lot of extra volatility that are in there. I agree with you. They're probably just resetting here. People want to have a reason to buy them. I just think those are different animals than the Wells Fargo, which is very different than JP Morgan. So we'll see a lot. I can't believe we're already back to bank earnings season here.
Yeah.
It's hard to believe.
But, bank earnings usually set the stage, and I thought that JP Morgan print and the stock market reaction to it, should have actually made people a bit more
I wouldn't
cautious.
own it here. I would not own it here. But again, if you have to own one, you need exposure. I think people,
and then, quickly after the bank earnings, which JP Morgan, again, started off pretty badly, but there was some pretty decent results from some of the other names that have lesser sentiment, better valuations and the like. It's interesting, and we talked about this a bunch. Meta, Netflix, a handful of other, big cap tech names, they gap much lower after their earnings, and they just all filled in the gaps, Danny. So what do you take from that price action? There's been some that have been left for dead. We can talk about Nike late last week. It was down 20% on Friday after its results in guidance. And, again, those don't have the sort of secular stories, let's say, that a Meta had or a Netflix have or something like that. So it seems like a lot of dispersion in the market right now between, names that underperform or give kind of lousy guidance. If you're part of the secular story, you're going to get back on the horse. And then let's talk about semis afterwards. But I'm just curious, that sort of price action, in hindsight, what did it tell you about investors and where they want to be?
I think the reason, let's talk about Netflix. The reason it was down was because they changed the way that they're going to report subscribers, and people freaked out. Meanwhile, they have all this other stuff going on. If anything, they'll tell you that it's no longer a, quote, subscriber growth story as it is on product offerings and what they're doing in live sports and all that stuff. So that was, and I think we actually talked about it on the show, a buy the dip moment for a quality company. And I think we're now back above where it actually printed from.
Much above. It got as low above 550, and it's trading at like
no, but I'm saying prior to reporting
right
from where it broke from and came back. So we're about Meta. Again, not that expensive of a name relative to the other big ones that are kind of out there. And I think it's a flight to safety. And they've had decent growth. Meta, the quarter wasn't bad unless I recollect completely wrong.
It was weird. I was sitting on the desk of Fast Money when the results were coming out, and they gave the guidance, and they basically guided revenues down like, a couple $1 billion on a very fat number, and they guided CapEx up a couple $1 billion. And the stock at one point in the aftermarket was down, 18, 19%. This is a company that's expected to do $160 billion in sales this year. And if you think about it, up 18% this year with a gross margin that is 81%. So I thought that was a really weird move. But again, just like Netflix, within a few weeks, it's on its horse and it's kind of filling in that gap. And here we are just below, those all-time highs made in April.
They're getting the benefit of the doubt,
Yeah.
obviously, to your point. And you can feel good about giving companies that are that big the benefit of the doubt. Those, companies have cash. These are, and they're in the right sector, to your point, and they're one of the Mag 7 or whatever we are at this point.
Yeah. So again, I mean, as you head into Q2 earnings, are there some sectors that you are kind of, like, to me, I think semis are a bit like really troubled here as far as like, they're going to be coming on some really difficult comparisons. If you think about it, the deceleration that we're going to see in NVIDIA, but some of these other names, have just been left for dead. Look at an Intel that's down, 38% in the year. And AMD is quietly really getting schmeistered here. It's only up 8.5%. Earlier this year, this was supposed to be the second best story. Obviously, Taiwan Semiconductor, which makes, I think, 85% of the global high-end GPUs, has been a great story. It's up nearly 70% of the year. ARM Holdings got involved on this. Supermicro is up nearly 200%, and then Broadcom is up nearly 50%. So there's plenty of names acting very well. But when you think about all of these customers of NVIDIA are dying for a second source for two reasons, right? For supply constraints and then pricing. You know that once you get a second source, they're going to compete on price. So again, to me, I think that 40% or so of NVIDIA's revenue comes from Microsoft, Amazon, Google, and Meta. If you were to see CapEx go from up just a little bit to down a little bit, that would signal to me that NVIDIA is going to see a bigger deceleration than the street has kind of modeled already.
You just said it. Intel and AMD are the two biggest competitors to NVIDIA. They have both said that they're developing, especially Intel, which I guess has its own fab. So they're vertically integrated in that regard. They're coming. It is amazing to me how much Intel specifically has lagged. I know they have other legacy businesses and people don't want to, right? But there should not be that much of a gap, to your point. And when it does come, whether it's a quarter, 2 quarters, or 3 quarters in lapse. And I want to say one other thing, because you and I weren't together last week. So Jensen Huang has been selling stock, okay? Let me just be very clear. These 10b5-1 plans that are, quote, set in motion.
That means they're scheduled
already. They have rules. The rules, you have no idea what the rules are. But he was scheduled to sell 6 million shares over the course of a year. He is north of 1.2, 1.3 million shares already in 2 weeks, because he had to freeze for 90 days. The first day he got an opportunity to sell, he hit the market. He has sold 3 days a week, 3 or 4 days a week for the last 3 weeks. And so, again, is it criminal? No. But ask yourself the question, why would he sell right now? Okay.
Why wouldn't he sell?
Why wouldn't he sell? But what are the rules? The rule, you don't know what the rules are.
Well,
you can alter a 10B. Hold on.
Yeah.
People need to look up these 10b5-1s. It's how you avoid insider trading. That's what it's set up for. It's how you avoid it. But you can have the rule, anytime the stock's above, anytime the stock trades more than 100,000 shares a day, I want to be active. It could be any bullshit.
Listen, his kids need braces. He needs to pay tuition. So why can't he sell stock daily? Well, one of the other points I wanted to make away from semis, so I just rattled off a bunch of names that act pretty well. This Supermicro in January at its lows was trading, I don't know, $300. And by mid-April, the stock was trading above $1,200. Okay, so now
they did an offering. They raised capital.
Good on them. Yeah. The stock is trading now at around $800. So down from $1,200 just a few months ago. Again, they put $2 billion on their balance sheet. This is a stock that when it started the year was in the Russell 2000 in the small cap index. But my point here is that the stock has not even sniffed that prior all-time high. Dell, which has kind of been, people have been excited a little bit about their, make a lot of servers that a lot of these high-end GPUs go in, and a lot of these, large language models or the training of them, they need servers and they need to go into these big data centers and the like. That stock was trading at $180 at the end of May. They reported the stock got as low as, I want to say, $130. It's come back a little bit to $140. And then we had Micron that had disappointing, at least guidance that people didn't feel particularly great about, especially how the stock was trading, and it's a fairly cheap stock. But, some of these AI adjacent names, investors are getting a little more picky. So again, if you see any weakness in guide, okay, on a CapEx basis, or just weaker than expected revenues from some of NVIDIA's biggest clients, who are also all working on developing their own chips, then you should see a bit of a downdraft, not too different than what we saw from the highs in 2023 from July to the lows in October, which is about 11%. And a lot of those names we just mentioned really underperformed the S&P 500 that time.
I agree. These stocks that are trading at 40 to 50 times earnings that people validate because the growth, in revenues is 5, 7, 10x. At some point, those kind of meet. And this stock may indeed be trading at 150 times 2026, 27 earnings. You don't know. But your point is, the minute that thing happens and there's confirmation that there's a slowdown either on the enterprise side of ordering or there's a slowdown in the ordering pace, you won't be able to find a bid on these stocks. And this is why I say, and I haven't been involved in this one in particular, this super microcomputer, but I go back to what is the buy point? And that's going to be the problem, is identifying what is the level where you can step in and buy it when the momentum does leave the sector. And it will leave the sector. And to your point, you make a good one, it has left pockets already within the sector. And so if they're not up now, what is going to take them to reaccelerate? And that's, I think, what you're really saying.
Yeah, and we just listed a bunch of names that filled in the gaps, right? Well, Dell has not filled in its gap, right? And there was a handful of these other names that have not done that. I want to hit big box retailers. The Walmart, you've been pounding the table on it for a very long time. It's trading at an all-time high. It massively outperforms, many of its retail peers. Danny, it's up like 30% of the year. And then the other one is Costco, which is also up about 30% of the year. So you've been talking about this trade down that we've seen in retail. The fact that I think the Walmart customer, the average income is now like $100,000. That must be up massively over the last few years. Do you worry about the crowding in these names, especially when you see like a Home Depot and a Lowe's? They're both flat or down on the year a little bit. And there's a handful of other retails, the retailers that act very poorly. Target's up, 3% of the year. So massive underperformance, the S&P 500. Is this, stock specific on some of these names, or is it a big of a macro thing? Like, how would you categorize this? And then I guess I would say is, do Costco and Walmart make you nervous on these runaway breakouts?
Yeah, the valuation alone is big. Again, relative to what you're trading at a 30 PE now, dividend yield's now 1.22% on Walmart. It was 3%, I think, when we started looking at this thing a couple of years ago. The Walmart customer is the one that is experiencing the best job growth right now in terms of pay gains, I should say. But if you have job losses at Walmart, Walmart's going to get hit. And at some point, if food prices also, Dan, if food prices start to abate, which has been the key driver for getting customers in Walmart's door, well, Walmart's done a great job on that. People that don't appreciate is their online business. It's growing. Yes, it's nothing near Amazon, but they are taking bits and pieces of Amazon's business away. And so I think that's one other area of the business which they've done a tremendous job on that warrants a higher multiple. But of course, Dan, at some point, I mean, you can't, this stock should not trade at a 35 multiple of earnings.
Yeah, I much prefer Amazon here to Walmart. And one of the reasons why you could talk about AWS and that growth bottoming, and you talk about some of the investments that they have made in a company like Anthropic and their own, large language models that they're trying to integrate. And again, they're probably going to get great productivity of that, great customer service gains and the like, but that's probably not for a year or two. But the leverage that they're starting to get in their retail business, just a few years ago, people were, valuing it at zero. It was all AWS, right? So again, I find that more interesting than Walmart. But one of the things I wanted to say about Costco, it's trading at its highest PE ever. It topped out in 99 at 40. It's trading at 53 times. Now, this is a company that's doing mid to high single digits earnings growth, okay? And it's, 5% sales growth. Yeah, they have that recurring revenue of the club stuff and everything like that. It's just not that interesting to me. And then Walmart is trading at like a 25-year high, like 30 times or so. And again, the growth is kind of, not particularly high one way or another. So again, Walmart's benefiting from a trade down, but at some point, if you do have a weakening consumer and higher unemployment, I think that even they are going to have a bit of a problem here. And the last thing I'll just say is like, there's got to be some consumer discretionary names that like are starting to look interesting. But when you take account for, Nike's 20% drop last Friday after disappointing earnings and guidance, and you look at Lulu, which has gone from 500 to 300 in just a handful of months or so, investors are getting a lot pickier, and especially on valuation, maybe not in tech, but they certainly are in some of these more economically sensitive groups.
I agree. So I think to your point on Amazon, it has a little bit of everything. You got a tech piece of it, you got a consumer piece of it. They've done an amazing job, obviously, with the company. Media that they're in. I mean, the stuff that they're doing is really incredible. And so is it expensive? Yes. Would you rather own that one or Walmart? Probably, given the fact that they have multiple levers to pull. And keep in mind, Walmart's hiccup, I can't remember what quarter it was over a year ago when they cleared out their inventory. They had the inventory reset. Stock got hammered. That was kind of the last chance you had to kind of buy the stock. My point is that there's a cyclicality to certain categories of things that will happen. It has to happen. It's a law of numbers, right? You have to carry X amount of inventory for what you think sales are going to be. And if sales drop in that category, it's down. So it is scary to think. I think, Dan, the better way to say it is, are these stocks, Costco and Walmart, priced for a hiccup? The answer is absolutely not. And you could see a big down day or two on these names if there were to have any type of missteps.
What do you think of the sentiment shift in Apple since June 10th? Okay, so we're coming on almost a month when they had Worldwide Developers Conference. They laid out their vision, how they're going to be implementing AI across their 2+ billion installed base. They're talking about, on device. They've done deals with OpenAI. There's rumors they're going to do one with Google for Gemini. They might do Baidu in China. This is meant to cause a huge upgrade cycle. I think investors obviously got in front of an upgrade cycle for the iPhone, which is, 50% of their revenue. But one of the things that's interesting to me is that, the faith that you have to have that their product right out of the gate, Apple Intelligence, is going to be the sort of thing that warrants an upgrade of your iPhone. Again, from a technical standpoint, if you don't have a 15 Pro, which is out there right now, you're not going to be able to run, a lot of these services. And so the thought that you're going to basically have to upgrade to a 1300 16 Pro to run a product that is based on Siri. And if you're an Apple iPhone user, you've had a probably pretty bad relationship with Siri. You got divorced from Siri years ago. You know what I mean? So I just think the uptake there is going to take a bit. And the last thing I'll just mention is it's trading about 33 times. That's a very high multiple for Apple. That, again, their service revenue, which is probably a lot of it is going to, a lot of this AI is going to drop down into that. Here's a company that's basically at all-time high margins at about 46% or so. So what percent of their sales has to come from AI that you revalue this stock that's very similar, let's say, to an Amazon or one of these other names or an NVIDIA or something like that? I also saw that Apple is trading near 9 times price to sales, the highest it's ever been. So again, we're seeing a pull forward by investors. This is not the company that's gone out there and told you what the TAM is and then told you, guidance that is very optimistic. This is investors trying to get in front of that. And that's the sort of behavior that makes me a little nervous, because in the last 5 years, there have been no upgrade cycles in the iPhone. And you may say, well, that's the point, right? It's time. There's hundreds of millions of iPhones that need to be upgraded, and this is the reason to do it.
It's definitely more cyclically exposed to the consumer than it had been in the past. So if this cycle is coming, you're talking about these phones are expensive, or whether you get them through the plans. And
I think you're going to say the cycle is coming, Ray.
Most definitely, Ray.
Yeah.
But it's, of course, there's always cycles. But listen, I just think it's playing catch up. I think that in recent weeks, the sell-off in NVIDIA, I think the money's gone straight into Apple. If you're a portfolio manager in Boston, you say,
well, that's a really interesting point. And again, I haven't heard too many people talk about that, but by Apple not creating their own large language model, by them not even having to pay to license OpenAI or Gemini, just think about it. They've saved billions, maybe tens of billions of dollars not being a customer of NVIDIA, right? And they're getting a lot of this stuff for free. And it goes back to why buy the cow when you get the milk for free? So a lot of these companies are accessing their installed base. They think that OpenAI thinks if they can get it out there and get hundreds of millions of people using this, that's going to benefit them in the future. But what do you make of the fact that investors have pulled forward this? Doesn't that set up for a disappointment if the upgrade cycle doesn't come in the way in which a lot of people think it might?
If that's the reason, I think the stock goes up and then you look back and say, why is the stock up? Oh, it's up because there's going to be an upgrade cycle. You have to justify these moves in these names. On a relative basis, Apple is not that expensive relative to the other names that are in the group. And so unless I'm,
well,
wrong,
those other names though have much higher gross margins. So like a Meta is 80, you know
fair,
what I mean?
but Apple on a
NVIDIA,
percentage basis has a lot of cash.
Yeah.
Right. And listen, the thing with Apple also is China. And I don't know what's going to happen with all the IP. I have no idea what's going to happen in the future with Apple. Are they going to be welcomed in China and their products? How much competition, is there going to be and so forth? But it's hard to see, to your point, growing into these multiples. Again, go back to 99, 2000. There was great companies. There's still great companies today that sold off 90%, 80 to 90%. I don't think we're going to have that situation here. And they had to basically get to another secular growth story and get through the gauntlet.
You say that, but from the highs in 21, okay, to the lows in late 22, NVIDIA sold off 75%. Netflix sold off 75%.
So
Tesla sold off 75%.
Yeah.
I mean, like, that's pretty astounding. These were also very profitable companies
I'm just saying,
back then.
could it happen? Yes, but I'm not going to be up standing here saying that's going to happen.
So one thing that's kind of interesting, we had this conversation on Fast Money a couple days ago, and I thought, again, I probably made a great point here, is that, these AI, this Apple Intelligence, okay, so supposedly there's 300 million iPhones in China, okay? This is a very high-end consumer discretionary buy for a Chinese, customer, right? But they love it. It's aspirational, that sort of thing. But there's also been a lot of nationalistic bullshit that's gone on where like certain government agencies said that, employees can't bring iPhones to work and the like here. And, Huawei and a bunch of these other local, phone makers have taken a lot of share from Apple. And so the one thing that I just think could be really interesting, there was a rumor a few weeks ago in and around WWDC that the company is speaking to Baidu because, again, Apple Intelligence is probably not going to make it past the firewall as it relates to China. Well, then if that's the case, and you look at a Baidu that's trading about 9 times earnings, it's got a good balance sheet, it's kind of been left for dead, you know what I mean? Like that could be a very interesting play on the heels of Apple.
Tencent, which owns WeChat, right? It's an interesting AI opportunity for them also.
Yeah, no, one of the things that's interesting that you bring that up is that, one of the criticisms about Apple's ecosystem is that a lot of Chinese who have lower end, smartphones, they use WeChat and a bunch of other sort of applications. They kind of piece them together. They're not all on one ecosystem the way Apple has built it out.
And then you got Alibaba.
Yeah.
Obviously.
Big cloud business there. So that one, again, these valuations are really attractive. And I'll say this is that, and I made this point on many occasions, is like, if you want exposure to some of those similar sort of technologies, it's a lot safer to be here. We know that the government in China was happy to take a chop at a bunch of these over the last couple of years, but right now they're down so much. The valuations are so cheap. If the play is to kind of do it on the heels of some of the advances here, thinking about it's in Chinese national interest, right, to have some very strong competitors, especially as the U.S. has built out. All right, one last thing, Danny. It's Tuesday morning, and we had Tesla's Q2 deliveries. And just my quick take, I said it on Fast Money last night, the way estimates have come down, the way the stock has traded over the course of this year, at one point it was down like 30+%, but the estimates came down so dramatically in the quarter for deliveries. It wasn't a good press by any means here. And I'll just say one last thing is that, but by the same token, when we get to earnings in a few weeks, the way that they've been buying down rates, right? So people could buy these cars. There's been massive downward pressure from just the price war that's gone on for about a year and a half or so. The fact that the stock is up, 8.5% or so today, what does that say to you? Because again, it's up about 65% from, I think, last month's lows or so. Thoughts on the delivery number, thoughts on basically sentiment, because the next important thing is going to be earnings that come in a few weeks.
Yeah. So let's keep this in mind that when May began, so, just 5 weeks ago, you had a 448,000 number there for deliveries. It was going to be in the quarter. It got revised down right before the print this morning to, let's call it 436. So it came in at 444,000. So they beat it. The production numbers were down to like 410,000. So they're obviously just selling inventory, which is what you're supposed to do, except if you're not manufacturing, right, obviously you can't have sales in the future. Also, their energy business, which again is a pimple on an elephant's ass, obviously grew. I didn't even look at the numbers because it's not meaningful. But here's the thing. The narrative that Musk has controlled since the quarter was reported, right, just a couple months ago, flies to China. Oh, they're going to allow robo-taxi stuff here. We're going to do that, right? Whatever. Sides with Trump, starts raising money, aligns himself with who he thinks is going to win to get political cover, or he thinks what could be political cover in the future, which is another part of the story, Dan, on the short side, is that Musk has broken a lot of securities laws, and at some point it's pay the piper, but he tends to get through all these things. So that's part of it as well. But here's what fascinates me, is that the people that own it, they don't own it for the auto business. They own it for robo-taxis in the future.
Oh, we're going to get a big show.
And all this stuff, big show on August 8th, right? Except on a day like today, when they see a marginally better than expected revised down delivery number, which, by the way, still down 5% year over year, it's an auto business again. Well, the auto business cannot justify the earnings, right? So people say, oh, well, you don't get it. Just break even an auto, get as many cars as you can out there, and then you'll have all these robo-taxis, and you'll be able to take advantage of all this data-driven. It's all bullshit, Dan, but it is what it is. But the fact that we've gone from roughly a $500 billion market cap to north of $700 billion here in the last couple of weeks, and by the way, it happened to leak yesterday what the delivery numbers were going to be. It flashed for a minute over in China, which is why the stock went from 200 to 210 yesterday. Just so we know, it's run basically 15% off of this number, entirely. So I'm still there. I'm going to stay there.
Well, let's see what the margins are when they report. Because again, buying down the yield rates.
So they're going to report July 23rd. We just found out. So
okay.
So I think that's what the earnings date that they just gave. So we'll find out then, and we'll deal with this all cycle again. But then no one's going to care because the hype's going to be 2 weeks later for robo-taxi.
Yeah, I just want to push back on one thing.
Please.
About the regulatory, reach as it relates to Musk in particular.
Okay.
I'll just say this, because he's the CEO of SpaceX, let me tell you something. We just saw this whole thing with Boeing, and they launched this Starliner, and they took some astronauts up to the ISS, or the International Space Station, and they got stuck there. So my point is the government, NASA in particular, they're really dependent right now on SpaceX. I just don't think they're going to come for Elon Musk because of that. I just think it's that important if you think about it, because we're in a space race again. You know what I mean? If you think about it. So I don't know. That's my 2 cents there.
Listen, you had Supreme Court rulings specifically about the SEC, about how if they want to go after civil penalties or all that stuff, it now should be in a court as opposed to just the SEC. So that changes everything as far as I'm concerned. And by the way, if you're a capital markets person and you want the rule of law, and you should care about those things, that literally you are basically taking power away from the agencies which are set up to basically protect you. Forget about Musk for a second. Forget about Tesla. You want them out there at least making people believe that they're going to be held accountable. And so to me, it's a sad day for that, because insider trading, all these things that can occur, that it just feels like the attitude now in the markets in general, we're going to get away with anything.
What are you talking about? We have a guy who's leading in the polls for president, who's 2 times impeached, had 90-some indictments against him. I rest
my case.
And 1 conviction. You think they're going to get Elon Musk?
They're not going to get. No, that's my point. Thank you. I rest my case.
All right, fair enough. All right, listen, that was a great convo. We got Guy Adami back next week on Market Call on the Tape. We're excited to have him back, and we're really excited for you guys to listen to this conversation that Danny and I had with Helima Croft. So stick around.
Welcome back to On the Tape. We are honored to have Helima Croft with us, Managing Director and Global Head of Commodity Strategy and Middle Eastern North African, so otherwise known as MENA, at RBC. You've been in the thick of things now for years, and never more applicable than right now. So welcome back to On the Tape.
Thank you so much for having me.
So let's start with what just happened kind of a month ago and work our way backwards, forwards, sideways. Was the OPEC meeting. Talk to us about why you decided to attend it. What does it mean to attend an OPEC meeting? Give us a little insight into kind of what goes on at these things.
Oh, fantastic. No, I mean, we had a little taper tantrum after the OPEC meeting when people thought basically OPEC was going to flood the market irrespective of any market fundamentals. But no, I've been covering OPEC for years, and I've been going to OPEC meetings for about 10 years. And there's such an atmosphere at these meetings where you get the opportunity before they go into their deliberations to interview the ministers. You called it the scrum, where you'd basically be given 20 minutes, run in, pick your couple ministers, ask some questions, fight off the reporters who are also trying to ask some questions with their camera crews. They then go into deliberations, sometimes multi-day deliberations. And then, the Vatican, there's a smoke signal goes up. They come down, they put the flowers on the table, and they give the press conference. And then you can read the statement and then ask the ministers questions about the agreement. And so we had a meeting that just took place at the beginning of June. It was supposed to be virtual, and that was a new development with COVID. They would not be obviously meeting in person during COVID. So they were meeting virtually. And there was an announcement the meeting would be virtual. We thought, okay, we'll just tune in on a Sunday. But on Friday, we started getting reports that 8 of the OPEC plus ministers would be assembling in person in Riyadh. And so I thought, well, if they're going, I'm going. So it became a bit of a run, Lola, run situation where at noon on a Friday, I didn't have my passport with me. I was in Washington. How would I make it on to the 10 p.m. flight to Riyadh? So
I know how you would make it on. You're former CIA. You know the underbelly of how all this stuff works,
well,
right?
Normally I would travel with my passport, but just a couple of weeks earlier, I had lost my passport and had to basically get an emergency passport to fly out to Riyadh. So sort of a theme here. And so then I've been sort of separating myself from my passport, but I actually had to get my passport, get on the plane, and make it to Riyadh in time for the meeting.
So sticking with that meeting, kind of the winks that you get or the body language, you know some of these people, they look at you a certain way when you ask them questions, right, about what's going to happen.
We develop a relationship with them. I think that's what's really important is that the repeated interactions at OPEC or another forum, sometimes I take investors to these countries, you develop a relationship where you can ask the questions, you can ask the probing questions, and they're receptive to it. Sometimes they don't want to answer the questions, but usually they're pretty receptive. And so I thought it would be very important, given the fact that we were at this inflection point in the market, we have so many barrels off the market, questions about the willingness of OPEC to continue managing this market. I thought it was worth it to try to get clarification on what they were looking to do.
Well, you had mentioned also that people don't understand that the new OPEC, or these days, are much better equipped to adjust in real time to supply and demand, and that you say it's a Zoom meeting now versus what it used to be. So explain that dynamic, because I think that was the takeaway that people like, oh, they're going to dump barrels onto the market.
I think, pre-COVID, you would have these meetings that would take place twice a year. You'd have a summer meeting, you'd have an end of year meeting. And it was pretty rigid. There really wasn't an easy mechanism to adjust. What we really started seeing with the evolution of the Zoom meetings, because remember, we had that massive collapse in demand. Right at the moment you had this Russia-Saudi price war in the spring of 2020, then Trump got everybody back together. We had the biggest production cut in OPEC history. They started meeting monthly to assess the state of the market. And so they came up with these mechanisms where if they would see something worrying in the market, they could pivot quickly in terms of policy. And so I think that is something that some newer observers of OPEC are kind of missing, that OPEC is not back in the mode of make a decision, see you in 6 months, live with the consequences. Now they're like, we will make a decision, but with the added language that we can adjust if necessary. And they do adjust if necessary. But I think what happened with this meeting is because there was no public press conference. There was a analyst and press call that took place about an hour after the statement was released. But because hedge fund traders did not see that press conference, and that was something during COVID, is that even if you were not participating in the analyst or press briefing, you could watch it. And so you could see how the ministers would respond to questions from a Brian Sullivan at CNBC or analysts. But if you don't see that press conference and you just get a piece of paper, I call it a Rorschach test. So if you go into that meeting with the view that OPEC has been doing too much work to manage the market, it should go back to a market share war, you're going to see something in that statement that confirms your bias, that that's going to be the policy path. If you see them laying out a timetable for bringing back barrels, you see that as rigid and inflexible. If you're someone of the view that OPEC is going to be nimble, you see the language that they're going to be meeting regularly to assess the situation, and you're like, okay, they're not going to overflood this market. But if you don't go on that press call, if you don't see it happening, you're just going to stick with what's on that paper. And I think that's what happened, is that you didn't have people prepared for any taper language. They see it, and they're like, sell this baby.
All right, before we get to some of the geopolitical stuff, when I look back to, let's call it mid-2023 for the price of oil, let's just talk about the volatility that we've seen. There was a huge ramp from June. It was about 40%. It got up to 95 from 70, and then it round tripped it. By the end of the year, it got all the way back to 70. When we think about, kind of risk asset volatility, we're sitting here, it's been a slow creep in equities higher. We did have about a 10% drawdown last summer in the S&P 500. And then what we saw for the start of this year is a move, back towards 90. It didn't get up to 90. And then it's just been a very volatile risk asset. So last year in 2023, was that about expectations for growth? And then I don't know, did they fall off towards the end of the year, or was it supply demand? And where are we right now? Because here we are with crude in the low 80s again. It feels like it's a bit in no man's land.
Well, I think what's interesting is, this time last year, I think what caught us by surprise was some of the supply stories. Like, I think we were not expecting such a big print on U.S. production. And then we had, strong production out of Brazil, Guyana, Canada. So I think there was a bit of a non-OPEC supply story that caught us by surprise. And then there was just, ongoing sort of concerns about the macro environment, about the Fed. And so I think this became an interesting issue about OPEC as well, because if I go to year end, we didn't have an in-person OPEC meeting. Because remember, over the summer, you had that in-person meeting in June, and you had the Saudis come out with this lollipop of an additional 1 million barrels a day that they were going to do by themselves. And I think that gave the market some confidence as well, because when Saudi says they're going to do something, like, Saudi is not a question of compliance. Like, they back their words with barrels. Some of the other members, you're like, but the Saudis were like, we're doing this. And so I think that June meeting gave people confidence on OPEC's willingness. But again, these other factors started creeping in terms of revisions on non-OPEC supply, worries about the macro picture. And then you had a virtual meeting in OPEC end of year that was delayed because they couldn't get everybody on the same page. And then you had a member, Angola, just leave. And then you had a sort of slow rollout announcements of individual additional adjustments. And again, I think for market participants looking at that, they didn't have that kind of clarity that you get when they go in person and they're saying, this is what we're doing. So I think there was a bit of a hangover as well from that OPEC meeting. And then, remember, year end, we had the war in the Middle East. And remember, we had this really big run up initially when people thought, wow, this is going to lead to Iran's involvement in a formal confrontation with Israel, because Iran has been the principal ATM of these extremist and terrorist groups in the Middle East. And so there was a view that there was an inevitable conflict coming with Iran. We had situations before where Iranians have targeted energy infrastructure. We can just look back to 2019 when they hit Abqaiq. They hit those tankers, right off of UAE. And so people went to like, oh my gosh, we're going to have supply disruption. And then when it didn't materialize, market participants were like, I'm fading this Middle East story. I'm going to focus more on the Fed and non-OPEC supply.
So when you think about, you were last year, I think at the end of last year.
Right.
And we talked about a lot of this geopolitical stuff, but the underlying thing was also what would demand be in China? Would look like it was going off of a cliff. It seemed to become, but more importantly, the rig count since then in the U.S., and I realize that's more micro than what you focus on, is dropping. And there's been a ton of M&A activity, mergers and acquisitions have happened. How does that change your thought, for the price of oil when West Texas versus Brent and so forth? We're going to get to the equities in a second, which I know is not.
Oh, not what I cover, but yeah.
What you focus on, but people that listen to this care because they use the input of West Texas and Brent for their decision making. But how does M&A, in your opinion, affect kind of the landscape on
Well, I think there's a view that with M&A, there's going to be more rational management of shale. I mean, that's the idea is when you have so many, companies out there, in private hands as well, there's a quest for growth. And so you have these big numbers put out there in terms of production because that's how companies are assessed. Now, obviously, companies have been punished as of late for investors in terms of quest for growth at all costs. But I think now there is a view that with M&A and more consolidation in the sector, you will have a more sort of rational development of shale patch, acreage. So I think there is a a bit of a watch and wait, though, in terms of how that's going to play out. But we're not anticipating the type of explosive growth that we had the year before.
It's just hard to gauge what is moving the price of oil, geopolitics or supply and demand.
Or CTAs.
Right.
I mean, I would say that what's really interesting now when we talk about this, recent run-up in prices.
So for our listeners out there,
systematic traders.
Commodity traders.
The machines,
CTAs,
basically,
exactly.
the algos.
Yeah.
And so what is interesting, because before, in preparation for this show, I was on our trading floor yesterday and talking to our traders, and they said, since the OPEC meeting, we had obviously people then starting to realize, okay, OPEC's not going to flood the market. So that was an overdone sell-off. But beyond that, it's also been kind of a quiet tick up. And you can't point to necessarily like, okay, there's this incredible bullish macro story that should account for this. Or there's been, consistent inventory draws that would point to a real tightening of this market. Now, we anticipate, tightening in the third quarter, but we're not seeing yet week after week inventory draws that would confirm that. So what is accounting for this run up? We're basically at 2-month highs. And there's a view that some of it is just algos, coming back in, the systematic traders. And is there just a sense that, okay, maybe the Middle East is a little more volatile than we had, anticipated? Maybe we should start focusing again on the supply risk out of the Middle East. But it's hard to pinpoint, is it macro? Is it fundamental? Is it just, systematic people getting back into this trade?
Well, the problem is it's inflationary and it's a direct hit to the U.S. consumer. So again, to bifurcate reasons that oil or the good and the bad of it all versus how it hits the U.S. consumer, it's a headwind for the Federal Reserve, I think, and they want to know exactly.
Of course.
So if there's a regime change in Washington, which I want to get into, and talk about what that means potentially to the price of oil in general, what it means to OPEC, what that would look like, because that's going to be an ongoing issue.
It's an ongoing issue for the Federal Reserve. It's also, obviously, you bring up the election as an ongoing issue for the Biden administration. I mean, they've already signaled a willingness to go back to strategic petroleum reserve releases in order to try to shield U.S. consumers from the inflationary impact of higher oil prices. The question is, what would the timing be? What would be the quantity of SPR releases? Remember, when they had the war break out between Russia and Ukraine, we did the biggest SPR releases in history. We were releasing 1 million barrels a day for 6 months. We've really run down the SPR.
We bought back very little.
We bought back. We keep saying we're buyback mode, but we're not buying back in any, huge quantities at this stage. So the question is, how would traders read a blockbuster release? It cannot be an infinite blockbuster release given where we are. And so the question is, is it a selling signal for oil? Or are you reading this as something, if you're requiring such emergency interventions, does that mean that this market is actually tighter than you believe? So
a lot of folks, like Danny just alluded to, are focused on the potential for a change in administration, obviously in the fall. When you think about it, didn't we drill more oil last year than we ever have in the history of this country? And so I'm just curious, what do you think about that? Is this likely to be a big change if there was one?
Well, I think certainly rhetorically, the Trump administration was from the beginning much more supportive of U.S. oil and gas development. I sit on the National Petroleum Council, and I went on to it under the Obama administration. So I feel like I saw the tail end of Obama, Trump, and now Biden on the MPC. And I think it's interesting just because to think about how the energy secretary addresses this gathering of CEOs, analysts, academics who cover oil and gas. And, the Trump administration just came in full throttle, American energy dominance, and talked about prolific U.S. oil and gas as enabling a foreign policy that would enable, punish our adversaries, go after Iran, go after Venezuela, but shield the consumer from the impact of that. So it wasn't only about sort of economics. It was also about America's place in the world, American energy dominance. Biden administration, on the other hand, came in and they were initially like, keep it in the ground. We didn't even know their view on natural gas. But when they were faced with inflationary pressures, they quickly pivoted. And remember, we had a situation where Biden administration officials were saying to companies, don't give the money back to shareholders. put it in the ground, and we want more short cycle development. Like, we don't do long lead time because you won't need it, according to the IEA, but we need the short cycle because we need to basically keep retail gasoline prices below $4 a gallon. So the question is, in terms of U.S. policy domestically, certainly I don't think there's going to be moratoriums for permitting on federal lands, but the Biden administration did. But when you talk to equity analysts, they said, look, those companies actually had basically all the permits they really needed for that drilling. So it was not really material in terms of shale development.
That was just politics. The way
was
it
was it potentially a virtue signal to, a base of the Democratic Party that very much cared about climate issues? Question is on things like, pauses on permitting for LNG exports. I don't think we're going to see that under Trump administration. I think they're going to be very, very encouraging of exports. But some of these issues around, for example, Keystone XL, which I think the Biden administration is still really criticized for setting the mood in terms of how they would approach the oil and gas sector. But Keystone also didn't go ahead under the Trump administration because it was getting held up in the courts as well. So I do think it's really an interesting question of, how much is materially going to change in terms of policy that gets more oil out of the ground. But the administration, I think, will be much more friendly to the sector.
Well, it's interesting. If you go back to 2000, late 16, 17, it feels like Trump was almost trolling the ESG groups by putting Rex Tillerson, as Secretary of State. And, there was a lot of that drill, baby, drill. So how would they top that? How would they top putting someone like Rex Tillerson in there? And again, if we're drilling a lot or a lot more, what does that do for the price of oil?
Well, that's an interesting question as well, because is it been government policy that has been holding back, shale production? Or has it been you've drilled the best acreage in the Permian? Is it that, shareholders will punish you? I mean, I remember sitting down with so many investors and, anytime a company, started adding to the rigs, you'd get punished. And so the question is was it capital markets that basically disciplined shale producers, or was it the government that disciplined shale producers? I think what would be interesting, though, in terms of the foreign policy side as it relates to oil is, are we going back to American energy dominance? And the question is, we have seen a significant rise, for example, in Iranian oil exports. They're at a 5-year high. And so I've heard Trump administration officials talk about the fact that essentially the ATM for Hezbollah, Hamas, the Houthis has been restocked by the Biden administration by letting these Iranian oil exports onto the market. Does the Trump administration come in and essentially say, we're closing the ATM, we're unplugging it, go somewhere else, for cash? And so will there be a more serious effort to take those barrels off the market? And I've actually spoken with previous administration officials saying, if you were in office now with the tools you have in place, because they're the same tools, the maximum pressure is still available. How much could you get off? And some former Trump administration officials say, okay, in 6 months, I could get 1 million barrels off. Now, others would say, the horse has left the barn. It's going to be difficult to get China to ratchet down imports. But at least when you talk to some administration officials, they say, look, if you threaten some of these, refiners and ports with being unable to access U.S. capital markets or deal with U.S. regulated institutions, if you essentially close the Malaysian laundromat because these barrels go to Malaysian ports and they end up being Malaysian exports, if you basically say to those Malaysian ports, which you now have the ability to under new congressional legislation, okay, we're going to sanction those ports, does that essentially make Iranian oil exports a stranded asset and it's off the market? Will the Trump administration try to take Iranian exports down? I think that's a really interesting question. Will it be a more coercive foreign policy towards Iran that basically is using sanctions as a tool to punish a regime?
So things may heat up prior to that, because we should talk about Israel and Lebanon's southern border, where Hezbollah is, which is proxy for Iran. That's not being priced in at all, but how realistic is it that this thing escalates, and how do we?
So what I think is interesting is I think we're starting to see it sort of creeping in. I talk about the creeping rally that we're seeing right now. I think it's a factor. I think market participants after April, when we had the direct exchange of fire between Israel and Iran, that's a market participants who are okay, either this kicks off or basically I can fade it. And I think people faded it after it was pretty clear in April that neither Israel or Iran wanted that direct confrontation. But this other issue, which has been with us from the start of this war, basically since October 8th, there has been this situation on Israel's northern border, Lebanon's southern border, where you've had, 60,000 plus people from the north of Israel basically say, like, I'm not living there. I'm not going to live under the threat of Hezbollah rocket fire after what happened on October 7th. And so the question always was the Netanyahu war cabinet going to take measures to try to reclaim the north? Essentially, are you ceding territory because the threat of Hezbollah rocket fire is just too high for people to move home? Or do you live with it and basically resettle them permanently, or do you take action? I think we're reaching the point now, because we've seen this since the middle of May to the middle of June, really surge in cross-border attacks. We've had, targeted assassinations, daily rocket fire, drone attacks. And so the question is, are we reaching some type of inflection point? And you've had a number of senior Israeli leaders essentially saying, like, no, we have to go in and force Hezbollah off the border. Now, there was the war in 2006. I'm really showing my age here. And it was basically a month-long war, kind of ended in a stalemate, actually. And the agreement was that Hezbollah would essentially retreat, significantly off the border, essentially on the other side of the Litani River. And so the Israelis have been insisting on, full implementation. It's called UN Resolution 1701. They've been calling for full implementation of that. Unlikely to get that. Hezbollah is essentially saying, like, we're not leaving the border until there's a permanent ceasefire. And so the Biden administration has been sending Amos Hochstein, to Lebanon, I feel like a couple times a month, to try to work out some type of arrangement that likely falls short of UN Resolution 1701. They move off the border, maybe not 30 miles off the border, but sufficient to give Israel comfort that people can move home. But we're not seeing any indication that we're getting there. And because Hezbollah is so important to Iran, it's the only successful export of the Iranian Revolution. Remember, the Iranian Revolution was supposed to go global. It was not just to be something contained to Iran. And so Hezbollah was created by the Revolutionary Guard. It swears allegiance to the supreme leader. They operate very closely together. You have IRGC officials essentially on Hezbollah operating committee. And so would Iran let Hezbollah be, seriously degraded by Israel? And I think many people don't think that's the case, because they may be willing to see Hamas and the Houthis, degraded, but they didn't actually give rise to these organizations. But Hezbollah is how they project power globally. Think about it. There are Hezbollah cells all over the world. And in my previous life, when we would run these sort of exercises where we would scenario plan an attack on the Iranian nuclear facilities, for example, there was a concern about how would Iran respond. And we would think about, well, could they close the Straits of Hormuz to internationalize the cost of the war? But also, could they essentially mobilize these Hezbollah cells globally? Places like Latin America, there are a lot of Hezbollah cells, West Africa. Could they use those cells to essentially target U.S. interests globally, European interests globally, in the event of a confrontation with Iran? And so I think that is always the way that Iran could give the West pause about attacking its nuclear program.
So you mentioned CTAs and algos that are trading oil. How deep is the market right now in oil? So would it take a lot then to send the price of oil higher? It's hard to see where the pockets of
well, so I think right now there is, I would say there's some political risk creeping back in, but I think it's not a barometer for the pressure building in the system. I think oil is a lagging indicator for geopolitical tensions. I think it is reactive. And so I think that if I were sitting in the White House, my concern right now would be, if we do see, and in terms of timeline, I think we're talking probably middle of the month we will know, because there's a sense that you can't do the Rafah operation and mobilize on the border. But once Rafah winds down, so watch for indications that you have, Gallant out there saying basically, Rafah is basically done, that would be the moment that you would say, okay, are we going to see a massive redeployment of forces to the northern border? And wherever we are in terms of price at that moment, I think then you need to start thinking about, are you $5 higher? Are you $10 higher? But that's, I think, if you're the Biden administration, that is the concern, that you're starting off already on a pretty elevated base in terms of prices. And so you put $5 or $10 on that, that's an uncomfortable place to be.
Back to the Hezbollah situation. So back in April, remember when the Israeli strike within Syria, were you surprised that the Iranians showed really so much restraint? I mean, they knew what listen, when they lobbed all those missiles over to Israel, they pretty much knew that they weren't going to actually have a whole heck of a lot of success, right? And so I'm curious, how close are we to a real dialed up situation? Because again, a Trump administration or a second Trump administration, they pulled out of the nuclear deal. They put, all those sanctions on them. And so when you talk about what is it, 5 or 6 barrels and where they predominantly going to China, that sort of thing. I mean, that's only going to get dialed up. And to Danny's point before, I mean, China growth is pretty bad right now. You know what I mean? So I'm just curious, how do you see that all shaking out over the next year or so? Because it doesn't seem like that the Netanyahu administration is going to let up. And if there is some provocation on the northern border, it sounds like they're going to go hard against that.
Well, it's an interesting question. I mean, do you really even need a provocation beyond where we are on the border? Or again, I take it back to the question of ceding territory and the fact that after October 7th, you have a traumatized Israeli population that does not want to be living in areas where you are exposed. And so you've had those people move off the border. And the question is, does the Israeli government, I think it's really a question of, does the Netanyahu government decide that they want to, lean into a policy of essentially trying to reclaim land in the north by creating a buffer zone in southern Lebanon that gives sufficient comfort for people to move back? And people talk about potentially before the start of the school year in September. And so I think that's really where the calculations that I think are important to try to figure out where this is going. I think the question is I think it's more a question of, what is the calculation in that Netanyahu government on this? And so I'd watch for somebody like Gallant very closely.
And what do the Iranians do? Let's just say, they're trying to push back, Hezbollah and trying to get back to some sort of normalcy. Do they understand? And again, they have an election coming up, right? They don't have a president right now. It seems like they might be in a little bit of disarray.
Well, what's interesting though is that we're going into a runoff in the Iranian elections, and all power in terms of foreign policy is really the supreme leader, and in conjunction with the Revolutionary Guard. But depending on who you get, we have a reformist candidate and we have an ultra hardliner in Jalili. And so it would be interesting if you end up with a situation, even though the president is not the one setting foreign policy, if the reformer were to lose and you get Jalili, who's very hard line, and you get a hardline president. Remember how Ahmadinejad was just so explosive in terms of his statements? To me, that would be a very interesting moment to have, essentially, we had a hardliner on Raisi, but this guy is even to the right of that. And so to me, that would be an interesting moment in terms of the messaging out of Iran, though it would still always be the supreme leader. But what I think the question would be, if you did have this war kickoff, did tanks, for example, roll over the border like in 2006, would Iran seek to directly fire on Israel? Or would you have, again, an internationalizing of the cost? Would they basically say to the various militias in Syria and Iraq, have at it, and let's start causing some issues in the Straits of Hormuz, and let's start targeting U.S. personnel, the thousands of U.S. troops that remain in the Middle East, start targeting those bases as well. So is it fought through these other proxies, or is it direct confrontation? I mean, what was interesting in April was what was, again, the catalyst for that, because the Iranians, again, they'll write the checks and they'll give the weapons, but they haven't shown this urgent desire to step in and save Hamas or the Houthis. But when we had that, attack on that consular building or a building in the consular complex in Damascus, that you had 8 IRGC generals, including the one who was running all of the Revolutionary Guard's operations in the Levant, so in Syria and in Lebanon, when you had him killed, and he was essentially overseeing the weapons highway. And it's a weapons highway that runs from Iran to Lebanon through Syria. He was the guy overseeing that weapons superhighway. He was killed. And so I think that kind of forced the hand of the supreme leader, because he has to deal with the IRGC. And they have been saying, like, look, we've had our generals killed. This is not the first time. You need to push back. You need to reestablish your own deterrence against these type of attacks. So that was the catalyst for that direct escalation. But as you pointed out, even then the Iranians were like, okay, we're doing this. And even the Israeli response, it was pretty telegraphed. But there is a view in Washington that once you get into a situation on this border and this, Hezbollah-Israeli confrontation, that it could go in a wildly unpredictable way. And the fact that the White House has been spending so much diplomatic capital in terms of trying to prevent this shows that I think they are concerned that this is something that cannot be contained.
So we have not talked about Russia yet at all in all this. So what's happening with their energy policy? Where are all the barrels? I know China's involved in both Iran and Russia, but how does Russia fit in right now? Are they just basically printing money at this moment?
Well, what's interesting is I think it's a case we can talk about both when it comes to Iran, when it comes to Russia. I mean, Russia has been, hit with a new round of sanctions, really trying to go after financial institutions that deal with any Russian corporation. But Russian oil exports have really held up. I mean, they have not been defunded either. And so it goes down to the question, when we think about issuing a verdict on the first 4 years of Joe Biden's presidency, how has this policy fared? Has the policy of essentially allowing Iranian barrels onto the market, or, they say they're going to tighten sanctions, they're not turning a blind eye, but you cannot argue with the fact that we have seen Iranian exports at a 5-year high. The Biden administration themselves kept saying when the war began, Russia-Ukraine, essentially, we're going to keep Russian oil on the market, hurt them by sanctioning other parts of the Russian economy, but don't hurt us by causing a market dislocation that sends prices, above $200. They were very focused in terms of their sanctions policy on keeping Russian oil on the market. Think about price caps. I think we talked about price caps at the time they were being instituted. And I kept saying price caps are not fundamentally designed to defund Russia. They're designed to keep Russian oil on the market. They're designed to ensure that we don't have a market disruption by enabling barrels that were going into Europe. And Europe basically said with the 6 package of sanctions, Russia, you're done. You're not sending your seaborne oil here anymore. And not only that, no EU service provider can move those barrels. That's when Janet Yellen was like, oh my gosh, there's going to be a 3 million barrel a day disruption if you can't have, a Greek flag tanker move those barrels. If you have, UK insurance, because the UK was following the EU on this, if Lloyd's won't underwrite that cargo, those barrels will be stranded. They'll be homeless barrels. And she worried about the inflationary impact of that. So price caps were designed to essentially ensure that the barrels that couldn't go into Europe would go into Asia. Now with a discount, but India was fantastic. I'm going to back up that truck. And you saw Russian exports to India soar. And those were allowed. I remember being on a certain TV show and one of the anchors was like, this policy is failing. Look what Modi's doing. I'm like, no, that's our U.S. policy, was to ensure that those barrels could go to India. Now, we set it at a discount, but that was, $60 was designed to ensure that, Russia would play along. And if Russia doesn't want to use a Western service provider or it's piped oil, it's not subject to the cap.
Well, it takes a true CIA analyst to try to figure out why U.S. needs Iran and Russia to keep exporting oil to maintain, this something that we have to keep oil prices lower. Because to your point, if you really go after them, you're kind of turning a blind eye, is what you're saying. What the U.S. is kind of doing.
We should have been a 60 bid for that oil for the
Exactly.
SPR refill.
What I think this goes to, and this is why I love going back to your question about when you ask about the rig count, is that, and again, I started my career at the CIA after 9/11. I literally walked in the door on December 1, 2001. And that was, a period where they were very concerned about U.S. energy dependence. Our dependence on foreign oil was seen as like crippling us in the foreign policy realm. And remember at the time, there was this writer called Matt Simmons who was like, Saudi's running out of oil, looking at Goar. And so we were like, oh my gosh, like what does this mean for the U.S. in terms of the economy? What does it mean for our dependence on these existing oil producers? Because U.S. production was in decline. And then we got the shale revolution. And then we thought, wow, this will either enable us to walk away from the Middle East, if we kept getting dragged back in, we could pivot to Asia. And it was this view that we didn't have to worry about any oil from anywhere else. But that proved to be elusive. It was basically, think about when oil prices collapsed in March of 2020. I'd been at that OPEC meeting and then went to Saudi for the G20 energy workshops. By the time I got back on March 7th, like at that moment, President Trump didn't know whether the prospect of like $30 oil was good because it could look like it was good for the U.S. consumer. But then you had all the shale executives being like, slow that roll, man, because like we can go out of business. Like American energy dominance ends if this price goes any lower. And then again, you had President Trump who came in like yelling at OPEC all the time. Like he had the OPEC of the 70s in his head. I remember he would tweet all the time.
He has a lot of things in the 70s in his head, to be honest with you.
But he really was like the 70s man on OPEC. He was like, you got these lines at the gas stations. But like once you had those shale CEOs being like, we're going out of business, he was like, okay. And then all of a sudden he became like the de facto president of OPEC. Like it was like surreal. You had this like massive Zoom OPEC meeting on the sidelines of the G20. And you had one of the countries in OPEC plus Mexico being like, we don't want to take the 300,000 barrel a day cut that we're supposed to take under this deal. The oil minister zoomed out. And like President Trump was like, I'm coming up with a Mexico fix. Like, don't worry about Mexico. So he literally went from being the OPEC critic to the de facto president. And to me, what I saw this as was we're not alone. Like shale's not Superman. Like shale was always dependent on an assist from these other producers. It was like a mutual dependent situation for shale. Shale depended on the assist from these OPEC producers.
Helima, how much, I'm sure you spent a lot of time thinking about the dollar movement. How much like focus have you had of late? We know what's happening on a few different crosses, right? So, Europe and the euro have been volatile against the dollar. Obviously the yen. I mean, do you spend a lot of time thinking about this?
Petrodollars, I guess, is what you think about, right?
Well, no, but we do think about it because what's interesting about oil is like who trades oil? We're not in a situation where it's just you have to worry about the physical traders of oil. I mean, we spend a lot of time now on systematic traders thinking about like, what are we thinking about in terms of the market that could be a trigger in terms of, either sell it or move higher. But like besides the algos, you have people who trade oil as part of a macro book. And I think if you're trading oil as part of a macro book, then you do start to think about the dollar. So I do think it's for a certain batch of traders in the oil market that are kind of tourist traders. You trade oil, like you might trade some equities, some FX, like the dollar is important. And so for that, we do watch it obviously because there's a segment of the market that pays very close attention. For the macro traders, the dollar is important.
Do you have to put targets out there like strategists, equity strategists and the like, or do you have, you're not constrained by that?
Well, we put out price forecast, but then we also sometimes we put scenarios in there as well, because you can say, okay, I think Brent prices are going to average $84.50 for the remainder of the year. But things can happen. I mean, again, we have a significant segment of production that is managed by OPEC. So you have to basically embed in that a call on what OPEC's going to do. You have to embed into it a call on demand, but you can get a demand surprise. Rates play a big role because of, again, a macro trader. And then you can just get like overtaken by a sentiment event. I think back to periods where we've had sell-offs in oil based on a broader macro concern about like the credit market in China, but you get towards year end, and then all of a sudden you look at the market and you're like, oh, oil actually held up. It wasn't spectacular, but it held up in China. And so you have to think about all these factors. And then geopolitics comes in as well. And we've had, two surprises. We had the Russian invasion of Ukraine. And then we had the situation where I think is evolving in the Middle East. I don't think we're done with this story. And I go back to what happened in 2019, because you brought up earlier, Trump was the guy of maximum pressure. We pulled out of the JCPOA nuclear agreement. Like, I remember two stories around how we pulled out that were important for oil policy. First, we pulled out in May of 2018, and the market was getting tighter. And we told Saudi Arabia and the rest of OPEC, we've left the nuclear agreement. We're going to take Iran to zero, but that's going to tighten the market. So guys, you go ahead and ramp up production. And I remember being at that June OPEC meeting, and a number of OPEC producers were like, well, we don't know until we get to October whether the U.S. is really going to zero out Iran or whether they're going to give waivers to allow some Iranian oil on the market. Like, why don't we wait till we make a decision? And we kind of really pushed Saudi Arabia to take the lead on this. And I'll never forget sitting in that basement of Vienna, and the Saudi oil minister at the time, Khalid al-Falih, came out and said, it's going to be 1 million barrels and Saudi will do it alone if necessary. And then we got to October and we issued 7 exemptions from importers of Iranian oil, and prices like collapsed to the 30s. And at that moment, I remember I was actually in the Middle East when it collapsed. And those Middle Eastern producers were like, whoo, we're never going to take ever again, good faith, you're telling us that you're going to take these barrels off the market. We're going to we're not going to do trust and verify. Like, you better take that off. You better act first, and then we'll support you. So when you think about a Trump administration and a return of maximum pressure, I think it's going to be hard to convince these countries, OPEC producers, to put more barrels on the market unless they see clear evidence that we're going to enforce those sanctions. They're not going to front run a production increase just because Trump says he's going to punish Iran. And the second part of that story, which is important, is when we decided a year later that we were going to try to take Iran to zero. We were going to impose maximum pressure sanctions. I remember sitting in this city, New York, and the then Iranian foreign minister, Javad Zarif, was making rounds in the city. And it was a moderate by Iranian standards president and foreign minister, though the supreme leader has always been a hardliner. And I'll never forget, the Iranian foreign minister basically said, like, look, you've totally undercut President Rouhani and myself with reimposing these sanctions. And if we can't sell our oil, no one's going to be able to sell your oil in the region. And you just watch and see what happens next. And like, I was actually flying into Abu Dhabi a week later. And as I'm landing, I'm on the Etihad flight. As I'm landing in Abu Dhabi, it comes across the ticker, Fujairah bombed. And I was like, oh, that's not awesome, because I'm actually going to Fujairah tomorrow. I was like, oh, great. And it turned out that didn't actually bomb this major port in the UAE, but 2 tankers that were basically at the port had been a mine had been placed on them, and they had basically been sabotaged. What was important about that? Why Fujairah? Fujairah sits outside the S-curve of the Straits of Hormuz. And so the UAE had marketed Fujairah as a way to de-risk the Straits of Hormuz. Like, you store your crude and chemicals at Fujairah, and you've got a clear path to Asia. And by hitting those tankers at that port, the Iranians were saying, you can't get away from us. Don't think you can de-risk us, and don't think there will be no payback for you pushing the United States to impose those sanctions. And over that summer, that was in May, we had a series of attacks on critical infrastructure in the Middle East, including the East-West pipeline, which is this 5 million barrel a day capacity pipeline that the Saudis could, in theory, use to move oil away from the Straits of Hormuz. Again, you hit the de-risking infrastructure, saying, you can't get away from us. And then on September 14th, 2019, they hit Abqaiq, the world's largest oil processing facility. They hit it in a spectacular attack with drones and cruise missiles, temporarily taking off half of Saudi Arabia's production. And in my previous life, we'd always been told abcake is the mothership of the global energy system. You hit abcake, everything goes down. Now, the Saudis were very quick in being able to get abcake back up and running. They drew from inventory. There was no ongoing disruption. But it was pretty clear to people looking at abcake that the Iranians could have done a lot more damage to abcake had they chosen to do so. It was a warning shot. And so to me, the question is, if we do see this Hezbollah-Israel confrontation, if it does come to pass and Iran does become involved, do we get a repeat of 2019? And again, I don't have to just basically come up with something in theory that they could do. I can just look back at 2019 and say, what is our proven capacity when it comes to attacking infrastructure? And do I believe that 2019 was the floor in terms of what they can do in terms of disruptive capabilities, or is it the ceiling? I think some market participants decided that 2019 was the ceiling, just like they decided in April the worst is over from this war because we had tit for tat and it led to nothing. But I remember people telling me, at least in 2019, that the mines were put above the waterline. They could have been put below the waterline. Put it below the waterline, the tanker sinks. And so I don't think that the Iranians necessarily in the current environment would have to close the Straits of Hormuz. Again, when we'd run these exercises, we could reopen the Straits in a matter of days. We could escort tankers through the Straits like we did during the tanker wars, during the Iran-Iraq war. But do they retain the capability to put a mine on a tanker and sink it? Sure. And in this current environment, what would that look like in terms of price? And could they hit pipelines again if they wanted to? Of course they could. So to me, the question would be, does Iran want to go back to that playbook of 2019 and use oil as a weapon to internationalize the cost of the war?
Well, by the way, this is so much more interesting than CTAs, dollar rates,
right?
Because this is like season 8 of Homeland right here. So
right.
you just, first of all, you demystified a lot of this
I'm
for us.
surprised Hollywood hasn't called you.
And then you made it really interesting. So,
that's why I love this market.
Yeah.
No,
but most commodity strategists don't speak like you do. They don't have the background. And
where you place a mine on a tanker?
No, below
water.
I just learned that. That was amazing. So listen, Helima, we're so fortunate to have you. I think this is like your 3rd or 4th time on the podcast.
I love coming on.
We really appreciate it, and we hope you'll come back
Thanks
soon.
for your wisdom, Helima.
Thank you so much.
Thank you.